Late last week, the U.S. shocked economists with a report no one really saw coming. The economy had grown at an unexpected 3.8% pace in the second quarter, seemingly putting to rest every concern about a slowing job market, trade wars, rising living costs, and even those growing whispers about an economic slowdown. On paper, it all looked amazing. But if you've been around long enough, you already know. GDP headlines never tell the full story, and this one in particular hides something much bigger. See, GDP isn't a perfect measure even in normal times. It's like judging someone's health just by their weight. There's a lot it doesn't show you. When you actually dig into the data, this latest report tells three stories that challenge almost everything we assume about how the economy works. And here's the punchline. The numbers might say growth, but what they really show is just how little you, the average worker, consumer, or small investor, actually matter to that growth anymore. To start, let's look at where this impressive growth came from. GDP is calculated by adding up all the stuff we consume, invest in, and spend through government and exports, then subtracting what we import. When the Bureau of Economic Analysis said the economy grew at 3.8%, it didn't mean we were all working harder or producing more. What actually happened is that imports, the stuff we buy from overseas, dropped massively by almost 30% in the last quarter. And since imports are subtracted from GDP, that decline made the economy look stronger than it really was. Why did imports fall so sharply? Because in the first quarter, retailers rushed to stock up before new tariffs hit, causing imports to spike by nearly 40%. Once their warehouses were full, they stopped buying. So in the next quarter, imports crashed. That swing alone added about 5% to GDP. In other words, if we ignored the import distortion, the U.S. economy would have actually shrunk by around 1.2%. But instead of headlines reading economic contraction, we got U.S. economy surges 3.8%. It's a perfect example of how data can make reality look better than it feels. Because the truth is, most of that growth came not from productivity or innovation, but from statistical quirks. And yet the markets cheered, policymakers relaxed, and everyone pretended the system was still working. But let's talk about what's really driving the American economy right now. And it's mostly consumption. About 68% of U.S. GDP depends entirely on people spending money. That's an enormous share, far higher than most developed countries. The problem is that this spending isn't evenly distributed. Half of all consumer spending now comes from just the top 10% of households. Meanwhile, the bottom 60% collectively account for less than 20%, and much of that is financed by debt. So when you see headlines about a resilient consumer, what it really means is that wealthy people are still spending, and everyone else is struggling to keep up. Even companies like Walmart are shifting their business models to target higher-income shoppers. Ferrari is worth twice as much as Honda. Entire sectors are chasing the few who can still afford to buy. That's not an economy built on broad participation. That's an economy built on indifference. A tiny group is keeping the lights on while the majority are being priced out of the room, and that's just consumption. When it comes to work, things don't look much better. Over the last 40 years, personal productivity in America has doubled. We're producing twice as much as before, even after adjusting for inflation. But median wages, they've only gone up about 20%. That means we're doing more, creating more, and achieving more, yet taking home barely any of the rewards. Sure, we can afford cheaper flights, cheaper clothes, faster phones, but the essentials, the things that actually matter like housing, education, and healthcare, have become absurdly expensive. So yes, we've upgraded our lifestyle, but not our stability. And the nature of work itself has changed. Technology made us more efficient, but also more replaceable. 40 years ago, office jobs required skill and experience. Now software can teach you to do the same thing in a week. Bank managers used to understand their clients and local economies. Now they just process credit reports. The value of human labor, of your ability to contribute, has been standardized, automated, and slowly devalued. AI is only accelerating that trend. It's not just replacing workers, it's reshaping how companies think about labor altogether. If most jobs can be done by anyone, or anything, then workers become commodities, interchangeable and expendable. The scary part? The economy doesn't actually need everyone to have a job for it to grow. If profits are driven by capital, by investments in automation, then growth can continue even as unemployment rises. We could literally have millions out of work while the stock market keeps hitting new highs. And speaking of the stock market, that's where things get even more distorted. The top 10% of households own over 90% of all corporate equities in America. Meanwhile, they hold barely any consumer debt. The rest of the population? They're drowning in credit cards and car loans while trying to invest a few $100s on apps like Robinhood. It feels empowering, but it's not wealth creation. It's survival dressed up as strategy. This means that most Americans no longer meaningfully participate in their own economy. Their spending doesn't move the needle. Their work doesn't command much value. And their investments, if they have any, are too small to matter. For the first time in modern history, the majority can suffer without the economy even noticing. The system can grow while most people fall behind because the engine is powered by a small elite whose wealth is self-sustaining. It's not even just inequality anymore. It's indifference. The rich don't need the rest to thrive, and the system doesn't need mass prosperity to function. That's why the Fed can struggle to help ordinary workers without boosting asset prices for the rich even more. That's why a stock market crash could now bring down the entire consumer economy, because the only people doing most of the spending are the same ones whose wealth is tied to it. And disturbingly, this idea isn't new. Back in 2005, Citigroup analysts wrote about something they called a plutonomy, an economy powered by the wealthy few. They said the world was splitting into two groups, the rich, who drive growth, and everyone else, who barely register. Their advice to investors was simple. Focus on companies that sell to the rich, because they're the only consumers that matter. That report was so revealing that Citigroup tried to scrub it from the internet. 2 decades later, here we are, living it. Economic growth exists, but it's detached from ordinary life. You can work harder, earn more degrees, even invest on the side. But unless you already belong to the small club fueling this machine, you're basically invisible to it. Yet there's still one area where you do matter, at least in theory: politics. Citigroup's own report admitted that while wealth was becoming concentrated, political power still technically followed a one-person, one-vote system. The biggest threat to the plutonomy wasn't economic collapse, it was democracy. Because the majority still has the power to vote for change. The tragedy, as they put it, is that we're really bad at using that power wisely. So maybe the question isn't whether you matter to the economy anymore. Maybe it's whether the economy, as it's currently built, still deserves to matter to you. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.